Hi, my name is Kareem Zakir, and I wanted to do this special capsule in order to address all the clients as to what is going on with the markets since January 1st of 2022. Clients have been worried with good reason. We've had 4 consecutive monthly drops in the bond market and in the stock market. This hasn't happened since 1970. And I wanted just to address the situation so that I can put your minds at ease. Things will turn around, but for the moment, as we're living through this correction, it seems extremely bleak. Sentiment is actually at the lowest rate it's been in a very long time. It's probably as bad as it was in February and March of 2020 when we were at the height of the pandemic. I don't know if you recall, there were shutdowns everywhere. People were wondering if they were going to lose their jobs. Everybody was stuck at home. Restaurants were closing. Airlines stopped flying pretty much. Our lives were turned upside down, and it didn't look like we were going to come out of it. But sure enough, we did. The markets in February and March dropped significantly. And believe it or not, by the end of 2020, all the portfolios, all the markets were all positive, some as much as 10 and even 12% for the year. For the ones who sold out in February and March due to emotions and fear, well, they lost out on a major rebound. And I've always said, sit tight. You do not lose your money unless you sell out of the market. I don't like the scenario. Unfortunately, it is not the first time I lived through one of these events. I've been doing this for over 30 years, and I've seen these market situations, these gyrations happen before. The good thing is that prices are currently being based on emotions, which makes absolutely no sense. This is why it is not a good idea to look at your statement on a daily basis. It will render you emotional and will make you do the wrong thing. So let me run through a couple of points with you. The first question is, why are the markets dropping so badly in the first 4 months of this year? Well, as you know, we've just come off a pandemic. There's a lot of supply constraints. The government was in the process of addressing the inflationary situation that was supposed to be transitory by slightly raising interest rates. However, a war ensued. We all know it. It's Ukraine and Russia. This terrible war is costing a lot of people a lot of heartbreak. But what's the war doing? Well, first off, Ukraine is a big producer of wheat and corn. And during a war, it is very hard to harvest and export wheat and corn. In addition, Russia is a big exporter of oil and natural gas. Russia is being sanctioned by many NATO members. So as a result, there's less oil going out, less natural gas going out, forcing prices higher. What a lot of people don't realize, it's actually a good thing for Russia, unfortunately, because they sell less oil, they produce less oil, but charge twice the price. I mean, the price on the markets have almost doubled in the last year. So it's ironic, but it is providing Russia with more revenues in order to continue fighting the war with Ukraine. Now, as a consequence of this war, prices are going up. That's very inflationary for the simple reasons that I just mentioned. And as a result, interest rates need to go up in order to curb inflation. Now, we don't have growth from a demand side. However, we do have supply constraints, which is very inflationary nonetheless. Market reaction? Well, as interest rates go up, the value of stocks and the value of your current bonds go down. We're going from a period of FOMO. If you recall, about a year ago, 2 years ago, we had fear of missing out on the markets. People were just throwing money at the market, paying any price for stocks. Currently, we're experiencing what I call FOGI. I made that up, by the way. Fear of getting into the market. People are fearful of getting in when things are so bad, and the markets have dropped over 20% in the case of the NASDAQ. So the funny thing is that the lower the markets go, the less the risk we're exposed to. Currently, we are living through a period of pessimism, maximum pessimism, which we haven't seen quite often, but we have seen in the past. Pessimism tends to sound more intelligent, it's more persuasive than optimism. Optimism, though, is the gradual recovery over time. And so tell someone that they're in danger and they will run for their lives. Tell someone that things will get back to even and they don't really believe it and they don't really listen. But I will tell you that the markets, the bond market, and the stock market will recover sooner or later. It always has in the past and it always will in the future. Actually, this is a great time if you've got money sitting idle to deploy capital in the markets. One of the great ways to do it is if you have a large sum of money, you can deploy a third of it now, a third of it in a couple of months, and another third a few months after that. That way you average yourself into the market because we never know where the bottom is. And so when the market rebounds and you're in the market, you're invested in the market, you will reap the rewards. At worst, stay the course with what you have. Now, I'm a bit of a history buff when it comes to the markets in general, and I want to cite you some examples of what's happened in the past. And had you invested during that moment, you'd be so much better off today. And even if you invested before the prior corrections, you still would have been way better off today than to simply liquidate the portfolio and bite the bullet. And I took an example of a 50-50 portfolio. 50% of this portfolio is in long-term treasury bonds, government-backed in the United States, and the other 50% is in the S&P 500. I used the United States as a benchmark because the United States tends to represent over 50% of all the world markets. If you go back to 1987, which is Black Monday, this 50-50 portfolio, as of September 1987, recovered as of November 1987. The drawdown during that period, during those 2 months, was a negative 16.39%. I also looked at the Asian crisis, which happened July 1997 to January 1998, where it was a drop of 3.19%. That's, again, a balanced portfolio. We've also had the Russian debt default, July 1998 to October 1998 with a negative 7.10. The dot-com crash, March 2000 to October 2002, that was a minus 12.21%. The subprime crisis, that's the financial crisis. I remember that one very, very well. From November 2007 to March 2009, the balanced portfolio dropped 20.39%. Lately, we've had the COVID-19 correction from January 2020. Believe it or not, it recovered end of March 2020. This balanced portfolio did a negative 3.51%. Had you invested in any one of those dire periods, you would have done extremely well the following year. This portfolio, by the way, had you just stayed the course, its average return was 10.25% before fees. Now, this is since 1978 till April 30th, 2022. That's the average return over that period of time. Most people say, I'm never going to live that long, or I'm not going to be invested that long. Nevertheless, if you just go back 10 years, you would have done almost just as well staying the course with this type of account. So just to wrap up, I wanted to put your mind at ease and suggest the best approach to this type of market environment is to sit tight. Things will turn around. They always do. I've just showed you proof in the past that things do turn around. And if you've got money sitting idle, this is one of those times where there are bargains across the board. So fear not, your portfolio has good government bonds that are guaranteed. It holds gold, and it holds blue chip, best of breed businesses that have been around longer than you and I have. On that note, I'll see you soon. Thank you for listening to me. To the next time. Bye.